Welcome to another deep dive.
Oh, this is going to be a good one.
Today, we're tackling capital budgeting.
It's fascinating stuff.
You've given us some excerpts from a corporate finance textbook that focuses on how Cisco Systems decided whether or not to launch a product called HomeNet.
Yes. This case study is a fantastic way to understand how companies wrestle with these really complex decisions when millions of dollars are at stake.
Absolutely. But before we even get to the go or no-go decision for HomeNet, we need to understand how to even figure out if a project is a good idea in the first place.
It all boils down to a concept called net present value, or NPV for short.
Got it.
The basic idea is if a project's NPV is positive, it's likely to be a good investment.
Okay.
But getting to that NPV number, that's where all the fun and the complexity lies.
So what's the first step in this financial detective work?
We need to forecast the project's future cash flows. Essentially predict how much cash it's going to bring in and how much it's going to cost.
Makes sense.
Over its lifespan.
And that's where this HomeNet case comes in handy.
Absolutely.
As a real-world example.
Yes.
For those not familiar, could you paint a picture of what HomeNet was all about?
So imagine this. It's the early 2000s. The internet is starting to become a bigger part of people's lives. And HomeNet was Cisco's vision for a wireless home networking device that would connect everything.
Wow.
Computers, phones, even things like heating and security systems.
It's ambitious.
They were targeting high-end homes and offices with this all-in-one solution.
Sounds pretty ambitious.
Yeah.
So how did they go about forecasting those cash flows for a cutting-edge product like that? Did they just pull numbers out of a hat?
Not quite. They started with detailed sales projections. So for HomeNet, they anticipated selling 100,000 units per year.
100,000?
At a wholesale price of $260.
Wow.
For 4 years. But then they had to consider all the costs involved.
Like the cost of actually manufacturing those 100,000 units a year.
Exactly. But it wasn't just manufacturing. They also had to factor in the upfront costs of research and development. A whopping $15 million total.
Wow.
Plus, there were ongoing costs for things like engineering, software development, marketing, and sales.
So that's a lot of moving parts.
Lots of different pieces.
How do you even begin to make sense of all those numbers and figure out if a project is financially viable?
That's where the concept of incremental earnings comes in. It helps us answer the question. How much will the firm's earnings change as a result of this project? So
we're not just looking at the total revenue and expenses. We're focusing on the specifically caused by the new project.
You got it. We want to isolate the impact of HomeNet on Cisco's bottom line. To do this, we have to consider all the different cost categories. The direct cost of producing each unit, the research and development expenses, even things like marketing and administrative costs.
And how do we account for those big upfront investments?
Good question.
Like the $7.5 million Cisco spent on equipment for HomeNet? Surely they don't just deduct the entire amount in year one.
Not at all. That's where depreciation comes into play. Even though that equipment was a significant upfront cost, its impact is spread out over its useful life. 5 years in this case. Each year, a portion of that $7.5 million is recorded as a depreciation expense, which reduces their earnings.
I'm starting to see how this all ties together.
Good.
But we've been talking a lot about earnings. Isn't cash flow what really matters at the end of the day?
You're absolutely right. Earnings are important for accounting purposes, but they don't always reflect the actual cash flowing in and out of the company. So
we have to make some adjustments to get from those incremental earnings to free cash flow. The money Cisco actually has to work with.
The money they have in their pocket.
What kind of adjustments are we talking about?
Well, for starters, we have to add back depreciation. Remember, it's a non-cash expense. Meaning Cisco didn't actually spend any cash on it each year. But we also have to consider other factors that impact cash flow. For example, the $7.5 million spent on equipment is a cash outflow that happens right away.
Okay.
In year zero.
Okay.
And then there's something called net working capital.
Okay.
Net working capital.
Okay, that's complicated.
It can be a little tricky.
Break it down for me.
Okay.
What is net working capital, and why does it matter for free cash flow?
Okay. So think of net working capital, or NWC for short, as the cash tied up in the day-to-day operations of our project. It includes things like inventory, the raw materials, and finished HomeNet units.
Right.
Sitting in a warehouse, ready to be sold.
Okay.
It also includes the cash Cisco has on hand to pay its bills, the money customers owe them, accounts receivable, and the money they owe their suppliers, accounts payable.
Got it. So
if Cisco needs to stock up on more inventory for HomeNet,
yes,
that would increase their NWC, which in turn would reduce their free cash flow.
Exactly. And the increase in NWC
means less cash available for other things.
Oh, okay.
And in the initial years of the HomeNet project, they projected a significant increase in NWC.
Okay.
About $2.1 million.
Okay.
Reflecting the fact that they need to ramp up inventory and manage those receivables and payables.
Okay. But isn't there a silver lining to this NWC story?
Yes.
What happens when the project wraps up?
When the project ends, Cisco would recover that NWC investment. They'd sell off their remaining inventory. Collect those outstanding receivables and settle their payables. This gives their final year cash flow a nice boost.
So it's like a temporary cash outlay that eventually comes back to them.
Exactly.
Okay.
So
we've figured out how to project those free cash flows.
Yeah.
But how do we determine if those cash flows are good enough to make the project worthwhile?
That's a great question.
That's where NPV comes back into the picture.
Yes.
Right.
Absolutely. Now that we have a solid understanding of HomeNet's projected free cash flows, we can calculate its NPV and see if it's a green light for Cisco.
Got it.
But there's one more piece of the puzzle we need. The discount rate.
The discount rate?
Yes.
What's that all about?
The discount rate reflects the riskiness of the project. Essentially, it accounts for the fact that $1 today is worth more than $1 tomorrow.
I get that.
The higher the risk, the higher the discount rate.
So a riskier project needs a higher discount rate to compensate for that uncertainty.
Exactly.
Makes sense.
Yeah.
How did Cisco determine the discount rate for HomeNet?
Well, they decided to use a 12% discount rate. Assuming HomeNet carried a similar level of risk as other projects in the router division. This is a common practice. Companies often look at the risk profiles of similar projects to determine an appropriate discount rate.
So we take each year's projected free cash flow, adjust it for the time value of money using that 12% discount rate, and that gives us the NPV? Simple as that.
Well, it's a bit more involved than that. But you've got the basic idea. For HomeNet, the NPV came out to a very respectable $7.627 million.
And remember, a positive NPV is generally a signal to move forward.
It is.
It means the project is expected to create value for Cisco.
Exactly.
But before we celebrate HomeNet's success, I have a feeling Cisco didn't just stop on plan.
They didn't.
Yeah.
They also wanted to explore different options to see if they could further optimize their decision. For example, they debated whether to outsource the assembly of HomeNet or bring it in-house.
Ooh, a classic make versus buy decision.
Yes, it is.
I'm intrigued.
All right.
Tell me more about how they tackled that.
That's where things get even more interesting. And that's a story for part 2 of this deep dive.
So we've established that HomeNet has the potential to be a profitable venture for Cisco.
Yes.
But as you mentioned, they didn't just settle for the first plan they came up with.
Oh, no. They wanted to explore all their options.
So tell me about this make versus buy debate. What were the key factors Cisco had to consider when deciding between outsourcing assembly or bringing it in-house?
The key is to focus on the cash flows that differ between the options. So, for example, outsourcing would cost $110 per unit, while assembling in-house would cost $95 per unit.
So on the surface, it seems like in-house would be cheaper.
Yeah.
But there are those hidden costs to consider.
There are.
How did they go about comparing those costs?
Well, they meticulously analyzed each option, projecting the earnings and cash flows for each scenario. They looked at not only the direct costs of production, but also how inventory requirements would impact net working capital.
And remember, tying up cash in inventory reduces free cash flow.
That's right.
And what did their analysis reveal? Was outsourcing the clear winner.
It wasn't quite that simple.
Okay.
Remember how we said a positive NPV signals a good investment?
Yes.
Well, when analyzing the costs of the two manufacturing options, both actually had negative NPVs.
Wait, so neither option was a slam dunk?
Not in terms of positive NPV.
How did they choose between two options that both had negative NPV?
Since we were only analyzing the costs, a negative NPV isn't necessarily a deal breaker in this case.
Okay.
Instead, they had to figure out which option was less costly.
Okay.
And it turned out that outsourcing was slightly cheaper with a present value cost of $26.2 million compared to $26.9 million for in-house assembly.
So even a seemingly small cost difference can make a big impact.
It can.
When we're talking about these large-scale projects.
Absolutely. Every dollar counts.
Yeah.
Especially when you're a company like Cisco.
Right.
Making decisions that involve millions.
But let's not get bogged down in the numbers too much.
Okay.
We've spent quite a bit of time discussing the mechanics of forecasting cash flows and calculating NPV.
Important stuff.
Right, and those are important foundational concepts.
They are.
But I'm even more intrigued by something you mentioned earlier.
Okay.
The idea that the real world rarely plays out exactly as we predict in our spreadsheets.
Yes, the ever-present challenge of uncertainty.
So how do we even begin to wrap our heads around uncertainty? Seems like an impossible task.
It is impossible to predict everything.
Right.
But we can use various tools and techniques to get a better handle on those uncertainties. One of the simplest is break-even analysis.
I've heard of that term, but I'm not exactly sure what it means. How does break-even analysis help us understand uncertainty?
Think of it as figuring out your safety net.
Okay.
Break-even analysis helps us determine the minimum level of a particular factor needed for a project to be successful, or at least not lose money for HomeNet.
Yeah.
Cisco calculated that they needed to sell at least 77,000 units per year to break even, meaning to have an NPV of 0.
Okay, so if they sell fewer than 77,000 units, the project would be in the red.
Exactly.
Okay.
It's a simple but powerful tool to help understand the critical thresholds for project success.
But what if we want to explore a wider range of what-if scenarios?
That's where sensitivity analysis comes in.
It sounds like we're getting into the more sophisticated tools in the uncertainty analyst's toolkit.
It's a good one.
Walk me through how sensitivity analysis works.
It's like a stress test for your financial model.
Okay.
With sensitivity analysis, we systematically vary key assumptions. Things like sales price, cost of goods sold, even the discount rate, to see how those changes would impact the project's NPV.
So we're essentially playing what if with our spreadsheet.
Exactly.
Like what if sales are 10% lower than we projected? Or what if material costs spike unexpectedly?
Precisely.
Okay.
By doing this, we can identify which assumptions have the biggest impact on the project's success or failure for HomeNet.
Yeah.
The most critical factors turned out to be, unsurprisingly, the number of units sold and the sales price per unit.
Makes sense. Those are the two biggest drivers of revenue. But sensitivity analysis seems to focus on changing one variable at a time. What if multiple things go wrong at once?
That's a great question, and it takes us to the next level of uncertainty analysis. Scenario analysis. It's like sensitivity analysis on steroids.
Okay, I'm intrigued.
All right.
Tell me more about this supercharged uncertainty analysis.
With scenario analysis, we can explore what-if situations that might affect multiple parameters simultaneously. For example, imagine a competitor enters the market with a similar product, putting downward pressure on HomeNet's sales price. At the same time, maybe a global shortage of microchips drives up manufacturing costs.
Oof, that's a double whammy.
It is.
How does scenario analysis help us deal with those kinds of complex interconnected events?
It allows us to model these what-if situations and see how they could impact the project's overall profitability.
Okay.
We might create different scenarios.
Okay.
A best-case scenario.
Yeah.
A worst-case scenario.
Yeah.
And maybe a most likely scenario.
Okay.
And project the financial outcomes for each.
So it's not just about identifying potential risks.
Right.
It's about quantifying their potential impact.
Exactly.
That seems incredibly valuable for decision-making.
It is.
It's like having a playbook for different possible futures.
It is.
If Cisco had done this type of scenario analysis and found that a competitor's entry would significantly impact HomeNet's profitability, they might have adjusted their pricing strategy or explored new market segments to stay ahead of the game.
Exactly.
It's all about being prepared for the
unexpected.
It's the unexpected.
But even with the most sophisticated models and analyses, we can't predict everything.
We can't.
There are always unknowns lurking out there. So where does human judgment come into all of this?
That's a great question.
Are we just slaves?
No.
To our spreadsheets and algorithms? Not at all.
Okay.
In fact, human judgment is arguably even more important in the face of uncertainty.
Okay.
Cisco doesn't rely solely on quantitative models.
Okay.
They also bring in the expertise of their business leaders and market analysts to consider those qualitative factors that are harder to quantify.
Like how the overall economic climate might affect consumer spending.
Exactly.
Or how a new technology could disrupt the home networking market.
Exactly.
It's about blending the power of data with the wisdom of human experience.
Wisdom of human experience.
Cisco uses a variety of approaches to understand and manage risk. Recognizing that no single method can capture all the complexities of the real world. I have to admit, all this talk about uncertainty and risk has got me feeling a bit overwhelmed. Is this something that only giant corporations like Cisco have to worry about?
That's a great question.
Or can any of these principles be applied to smaller decisions, even personal ones?
That's a great question. And it's something we'll explore further in the final part of our deep dive into capital budgeting.
Stay tuned.
So we've been talking about how Cisco used all these complex financial models and analyses to evaluate a major investment like HomeNet. But you raised a really interesting question at the end of the last part.
All right.
Can these same principles be applied
to
smaller scale decisions?
They can?
Even personal ones?
Absolutely. The scale might be different. But the core concepts of capital budgeting are surprisingly versatile. At its heart, capital budgeting is about understanding the financial implications of your choices and making informed decisions that align with your goals.
That makes a lot of sense. So if I'm trying to decide whether to invest in a new business venture,
or even something like buying a house, I could use these same tools to analyze the potential costs, benefits, and risks involved.
Exactly. Let's take the example of buying a house. It's probably the biggest financial decision many people will ever make.
Yeah, it is.
And while it's certainly an emotional decision, it's also important to approach it with a clear-headed financial perspective.
So instead of just falling in love with a charming kitchen or a spacious backyard, I should also be thinking about things like cash flows, NPV, and risk assessment.
Well, you don't necessarily need to pull out a spreadsheet and start calculating NPV. But the underlying principles can be incredibly helpful. Think about the upfront costs. Not just the purchase price, but also things like closing costs, property taxes, and insurance.
And then there are the ongoing costs. Mortgage payments, utilities, maintenance. Maybe even HOA fees.
HOA fees?
It starts to add up quickly.
It does.
And those are just the costs.
Those are just the costs.
You also need to consider the potential benefits.
The benefits.
Is the house in a good school district? Is it likely to appreciate in value over time? Could you rent out a room or a basement apartment for extra income?
Exactly.
And, of course, there are the risks to consider.
The risks?
What if interest rates rise, making my mortgage payments less affordable?
Right.
What if the housing market takes a downturn and I need to sell at a loss?
You got it.
By thinking through these potential costs, benefits, and risks, you can start to get a clearer picture.
A clearer picture.
Of whether buying a particular house is the right financial decision for you.
Exactly. And this same framework can be applied to countless other decisions.
Okay.
From starting a business to investing in your education.
It's like having a secret weapon.
It is.
For making smarter decisions, both big and small.
Both big and small.
Speaking of secret weapons,
okay,
there's one concept we touched on earlier that I think deserves a little more attention.
Okay.
Depreciation.
Depreciation.
Often misunderstood.
Often misunderstood.
Incredibly important in the world of finance.
In the world of finance.
Remember, it's not a direct cash outlay.
Right.
But it can have a real impact on a company's cash flow.
Yeah.
Thanks to something called the depreciation tax shield.
Ah, yes, the depreciation tax shield.
I have to admit that phrase, depreciation tax shield, sounds a bit intimidating.
Another mouthful.
Can you break it down for me in a way that even someone who's not an accountant
Absolutely.
can understand?
Let's go back to our HomeNet example.
Okay.
Remember? Cisco invested $7.5 million in equipment that would last for 5 years. Now for accounting purposes. Yeah. They can't just deduct that entire expense in year 1.
Okay.
Instead, they have to spread it out over the equipment's useful life.
Okay.
This is depreciation.
Okay.
Essentially recognizing that the equipment loses value over time.
So it's like saying my vintage record collection appreciates in value while my car depreciates faster than I can say net present value.
Exactly.
But here's the key point.
Okay.
Even though Cisco is recording that depreciation expense each year, they're not actually spending any cash on it.
Right.
So where does the tax shield part come in?
Okay, so depreciation is a deductible expense.
Okay.
Meaning it reduces Cisco's taxable income.
Okay.
And lower taxable income means they pay less in taxes.
Right.
Which puts real cash back in their pocket.
Okay.
This is the magic.
The magic.
Of the depreciation tax shield.
So even though depreciation itself isn't a cash flow, it indirectly boosts cash flow.
It does.
By reducing a company's tax bill. It's like a hidden bonus.
It is.
It's a great example of how seemingly dry accounting concepts can actually have real-world financial implications.
They can.
And it highlights why understanding depreciation is so important in capital budgeting.
Yes.
This has been a fascinating deep dive into the world of capital budgeting.
Absolutely.
We've covered so much ground.
A lot of ground.
From the basic principles to the complexities of forecasting cash flows.
Yes.
Analyzing uncertainty and even uncovering the secrets. Of the depreciation tax shield.
That's right.
What are some of the key takeaways you hope our listener is walking away with today?
Well, I hope this deep dive has demystified the world of capital budgeting and shown that it's not just a bunch of complicated formulas and spreadsheets.
Yeah.
At its core, it's a framework for making thoughtful strategic decisions about how to allocate resources. Whether you're a multinational corporation or an individual making a personal financial decision.
I think that's a great point.
Yeah.
We've seen how Cisco used these principles to evaluate a major investment like HomeNet. But we've also discussed how these same ideas can be applied to everyday decisions. Like buying a house or starting a business.
Exactly.
It's all about understanding the potential costs, benefits, and risks involved in any decision. And using that information to make choices that are aligned with your goals. And I think it's important to remember that no one has a crystal ball.
No.
The future is inherently uncertain.
It is.
So being able to analyze and manage risk is crucial for success in both business and life.
You've hit the nail on the head.
And speaking of risk, remember how Cisco considered the opportunity cost of using equipment they already had for the HomeNet project? Yes. That equipment could have been sold for $2 million.
$1 million.
They had to weigh the potential benefits of using that equipment for HomeNet against the potential cost of missing out on that $2 million sale.
Exactly.
That's a great example of how opportunity cost factors into capital budgeting. It's about recognizing that every decision has trade-offs.
It does.
And sometimes the best choice is the one that maximizes the value of your resources, even if it means foregoing other potentially attractive
options.
I love how this deep dive has given us not only a glimpse into the inner workings of a tech giant like Cisco, but also practical tools and frameworks that we can apply to our own lives.
It's been a true journey of discovery.
It has. It has, and I hope it inspires our listeners to approach their own financial decisions with a bit more clarity, confidence, and maybe even a touch of excitement.
A touch of excitement.
That's a fantastic note to end on.
It is.
And if you're hungry for more insights into Cisco's capital budgeting process or how they navigate the complexities of risk management, I highly recommend checking out the full interview with David Holland, their senior VP and treasurer, in the source material.
It's a fascinating read.
Until next time, happy budgeting.